Do you need help protecting your finances as you enter retirement? David Dickens of KC Financial Advisors has got you covered. Welcome to the Cover Your Assets KC podcast.
Thanks for joining us for another edition of the Cover Your Assets KC podcast. Walter Storholt with David Dickens, President and Wealth Advisor at KC Financial Advisors. You can find us online at coveryourassetskc.com for past episodes of the show and much more information and resources. David, we're going back to basics on today's show. We're going to be talking about some financial literacy elements, really the three qualities of money on the agenda today. This should be pretty fun. Do a lot of people know what the three qualities of money are when they come in to meet with you for the first time?
Well, they could probably guess on a couple, and maybe their three qualities aren't the same as mine, or the same as yours. But what we're going to talk about today are very foundational principles that my business and financial security are built on. So I'm excited to be talking about it. This is something I learned. My first job in the investment business was in the bond department at United Missouri Bank in 1981. And these three things are the first thing I ever learned in the investment business. So
that's pretty cool.
That's where we're going today.
The three qualities of money. It's green, it's made out of paper, and it burns if you light it.
Now there you go. See, all those are true.
Technically true. Not what we're going for today, but technically true.
No.
Right? No, this is a good episode for you if you would like to learn a little bit more about why the investment and savings and financial world is what it is, and why isn't there a magic bullet product that can achieve all the things that we need and that we want. That's kind of the basis and the fundamental understanding that we're getting to on today's show. I think that this will actually be really educational. I know the first time I learned about the three qualities of money, at least the ones we're talking about today, it was just very eye-opening, helped connect a lot of dots. First time we I ever went through this with somebody. So I think it can make an enormous difference in somebody's financial life. It's going to put things in perspective the right way for somebody out there. All right, so let's define our three qualities of money that we want in a portfolio, David. What are those that we're talking about?
So all investments have these three in varying degrees. And since 1981, I've used this acronym. It's the SLY principle. They all have safety, liquidity, and yield. Some people call it growth, but I use the SLY principle. Safety, liquidity, and yield. Safety, will I get the money back? Liquidity, when can I get the money back? And yield, well, how much will it have grown when I get it back? All investments have those three things, and those are the foundation of the investment choices that we have as we're putting our money to work for ourselves.
That's a great point. I like that, the yield better, so it's a better acronym because the G, S, and the L just isn't gonna flow as good. So SLG, I think, is what that one. So SLY, SLY gives slug.
I like the SLY principle better.
I think SLY sounds a little bit better. So obviously, I kind of know the answer to this question, but people often will look for a single investment that achieves all three qualities at once. Why can't I have a product that gives me growth, safety, or yield, safety, and liquidity all in one thing?
Yeah, so the answer is it's just the basic trade-off. It's one of the natural laws of investments. You can't have
Newton would have discovered this if he had lived just a little longer, right?
Exactly. He was so close. The biggest example is one of the investment products I hate the most, where they've tried to give you all three in one wrapper. Do you have a guess as to what that is, Walter?
No, what's
that?
Because
I've railed on these before.
What is it?
It would be a variable annuity.
Oh, that's right. I had pushed it out of my mind because of your railing.
Good for you. So a variable annuity, I'm not talking about fixed annuities. I'm not talking about fixed indexed annuities. I'm talking about variable annuities. They are an investment vehicle put together by life insurance companies which smash together the insurance component and the investment component. And what mostly comes out of them are very high annual fees that you, the investor, are going to pay come heck or high water. I've looked at more than 100 of these for people that have walked through my door over the years. One I'm going to do is very typical. Not that long ago, we looked at one that was a $250,000 variable annuity. And its annual fee structure was 3.5% every year.
That's a lot, right?
That's a lot, but that's normal for a variable annuity. Well, that's over $8,700 a year. If you hold that annuity for 10 years, which based on the restrictions they put on it, you're going to hold it for 10 years. That's 87 grand in fees that you paid because I don't mean to say this negatively, but some salesperson told you that you could get safety, liquidity, and yield all in one package, and you can't. So I'm sure we have a show where I railed on variable annuities, but that's the best example of you being sold something where you thought you could get all three, but you can't.
I'm doing my best to search our archives to see when the last annuity show that we did was, David, and I have found it. And as you would imagine, we'll put a link in the description of the show for you to go find that old show. It is episode 83. We don't just talk about variable annuities, but we dive into all four types of annuities and give you a good breakdown of each one and some of the pros and cons of each and what you need to know. It's a very good educational episode, so go check that out. Episode 83, we'll link to it in the show notes of today's show. There it is. All right, so that's very good, David. I understand we have the yield or growth, safety, liquidity. That's what we're after. To help drive it home a little bit, can we talk about where maybe different investments that we're familiar with, using that variable annuity, the one that tries to do all three, and thus kind of the inefficiency that we see in it. Can you give us some idea of where other types of investments and savings, where they fit into these three qualities of money?
Yeah, sure. So as you're putting together your financial life, you're going to want to strive some semblance of a balanced portfolio. That doesn't necessarily mean just your 401k. It means your financial life. So one of the pieces you're going to have, especially if you are up on your financial New Year's resolutions, is you're going to have established an emergency fund. That's just your bank. Typically, that's your bank cash. Maybe it's in a money market fund. Maybe it's in a checking account. Maybe it's in a savings account. You and I and everybody listening knows those accounts earn almost zero. Now, years ago, you might get 2 or 3 or 4% on a money market account, but not today. You earn usually less than 0.5%. So they're super safe because of FDIC insurance. They're liquid. You can go get that money anytime you want with no penalty. But honestly, there's no growth involved in that. In fact, if inflation's running at 2% and you're earning 0.5%, then every year your money has lost 1.5% of the value just from inflation. So that, in the SLY principle, you get safety and liquidity, but no yield.
It's a good example. That one makes sense. Any other examples or comparisons between?
Yeah, so I think most people's experience with this is going to be in their 401k or their IRA. So stocks, bonds, and mutual funds.
Yeah.
So those are marketable investments. You get them from a brokerage house or through your 401k or wherever you happen to get them. But those typically have liquidity and yield. Now, stocks can go down too, so it could be a negative yield. But you buy those three things with the expectation that over time they're going to go up in value, so they're going to earn some yield, some growth. And they're going to be liquid because, frankly, you can go get that money. You can sell that stock or bond or mutual fund any day you want. But they're not really considered to be safe investments. Bonds, safer than stocks. Mutual funds are the same as stocks because they're a basket of stocks. Or you can have a bond mutual fund that's a basket of bonds. But in that world, in the marketable investments, stocks, bonds, mutual funds, you don't get safety, but you get liquidity and you get yield.
Makes a lot of sense. Yeah, I like your the yield does make sense because we're not talking about just growth in those situations. I guess it's the potential for growth is what those different investments have, but no safety because that growth can turn into negative yield if we want to throw a whole bunch of buzzwords in there together. But I'm tracking you. I'm tracking you well. All right, you mentioned variable annuities, but then we also talked about how there are multiple types of annuities. So do the other annuities fit into particular qualities?
I think they do, and that's what I use them for in my practice. So a fixed annuity, if you go back to what was that show, 80?
83, something like that, I think, yeah.
Something back there. Check the notes to the show.
83,
but a fixed annuity is basically, has all the attributes of a bank CD except that it's issued and guaranteed by an insurance company instead of a bank. So it has a fixed rate of interest, it has a fixed period of time, And it usually has an interest rate, a yield, that is maybe double what a bank CD is going to offer you. So a fixed indexed annuity has a different way it earns interest, but neither of those two types of investments can go down in value, and that's where their safety comes from. So they have a little bit of growth as an interest rate. They are safe because they can't go down in value, but they have limited liquidity. Sometimes interest only. Sometimes you can take out 10% of the money you put in each year without any penalty. Tax consequences will vary. But let's say you bought a $100,000 fixed indexed annuity, and next year you say, oh my gosh, I need some money. Well, the annuity company will let you go get $10,000, 10%, without any penalty for early withdrawal. So they have limited liquidity. But what they're really there for is some growth, the promise they won't go down in value, which is the safety component.
Makes sense. And you can start to see, I think, the picture here, David, of how we have, cash, stocks, bonds, mutual funds, annuities, all starting to fill different roles of growth, safety, and liquidity. I'm curious, though, what about real estate? Just because I know that's another popular investment and retirement strategy that people lean on. Where would real estate fit in with its qualities?
Yeah, so I own a couple pieces of real estate. I think I've mentioned that before in these podcasts. I've got clients that own rental real estate. And then, of course, if you own your house, well, that's a piece of real estate too, and that is absolutely positively part of your financial foundation, your financial picture. All of those, whether they're income producing or whether it's your house, they typically go up in value. 2008 and 9 maybe is the exception, but typically real estate goes up in value. So it has some yield or growth component to it. They're pretty safe because typically prices of houses don't go down. However, the liquidity is super limited. Now, if you own these things, you might say, well, Dave, I can go borrow against my properties anytime I want. And that's pretty much true. But it was very hard to get a bank loan in 2008 and 2009 if it's based on real estate. And then it's based on the value of your real estate and the lender's willingness to loan you money. Banks are famous for lending money to you when you don't need it. But when you do need it, when your circumstances have tightened up, the access to liquidity gets way more difficult. So real estate, I think, is a good diversifying asset. It's pretty good for growth. They tend to be pretty safe investments, but you do have limited liquidity. So that's kind of the waterfront there, Walter. The cash, because you need some. If you got to get your hands on money fast, you need some cash. Stocks and bonds and mutual funds, you got some growth and liquidity, but you really don't have safety that you can count on. Fixed and fixed indexed annuities, you got some growth, some yield, you got some safety, but liquidity is real limited, and that's the same thing with real estate. Good attributes, except they're not very liquid.
Yeah, and the safety maybe not as safe as some of the other ones either. So a little bit of a couple of question marks around that one. Another note on the real estate, just because you mentioned banks kind of can do their own thing. Just, we were kind of redoing some things around the house. I was just exploring doing, like a HELOC or something like that as a chance to, help fund maybe a kitchen reno or something like that. And it was just interesting. I was wondering what the rates would be, but I saw that there are apparently Wells Fargo and another bank have stopped all HELOC loans. It's not in their best interest to do them right now because of the way the rates and the environment is. And so just like that, they said, nope, we're not going to do them. And so if that's who you were going to be relying on for, that particular help, just a good illustration of how quickly those things can change and take away an option. And that's why it's so important to have different things that help you achieve the growth, safety, and liquidity that we've outlined today.
Right. Those are the basic principles of diversification. So using all four of those, most people aren't going to use real estate other than the house they own, but using the other three, cash, stocks, bonds, mutual funds, and maybe an annuity or two, those are ways to diversify your financial assets such that you get the right amount of safety, liquidity, and yield that benefits you and who you are.
As most things, it's easier said than done, though. So do you find people putting too much emphasis on one of these qualities over the others? And then how do you fix that if it's a problem?
Oh, all the time.
Okay.
And so that kind of boils down to what somebody's personal risk tolerance is. And that's one of the first things, way before we enter into a relationship with anybody. It's super important for me to know, who is the person on the other side of the table for me? I know what their numbers look like, but who are they inside? When the stuff's hitting the fan, how are they going to react emotionally to their money going down in value? So, for instance, if somebody's got a really low risk tolerance, they probably have way too much money in bank investments and annuities, and not enough in growth, like, for instance, stocks, certain bonds, whether they do stocks as individual or mutual funds, but things that are going to add some growth and some inflation protection. So in that case, the low risk tolerance person has a tendency to spend down their nest egg too quickly in retirement. Most of the people that I work with have a moderate risk tolerance. And typically what happens in that situation is they get more and more aggressive, some call it greedy, as the market's going up and up and up. But then when the whole thing changes course and you have a major downturn, they can get pretty fearful pretty fast, which causes them to do exactly what they don't want to do, have too much invested at the top and sell at the bottom. So the moderate risk tolerance person has themselves as their worst enemy. And then I have some high risk tolerance clients. And those folks tend to invest in things because they're not financial professionals. Maybe they're engineers or they were doctors or whatever they did for a living. But they tend to get interested in and invest in things they don't understand. And they typically understand the upside, but there's something about the downside they just didn't quite think through when they agreed to buy the investment. So I see risk tolerance all the way across the spectrum. And it doesn't really matter. It doesn't coincide with how much you have. It coincides with your feelings about money. And so that's way high on my list in the profession I'm in, is to understand not only what does somebody have and how much risk they're taking, but how are they going to react when it starts going south. And that's a super important part that makes me a successful advisor with clients, as opposed to getting them too far out on the risk spectrum or not far enough out on the risk spectrum, which makes me an ineffective advisor for that particular client.
All about bringing these things into balance. You know, we think about balance and diversification. It's not just about the right mix of stocks and bonds. It's the balance of these different qualities of money. And that's why this foundational conversation, I think, is so important. Growth or yield, safety and liquidity. Those three things, so important to make sure that they're all represented inside your plan and portfolio. Just don't go looking for the magic bullet that's going to solve them all at once. That's where the balance and the delicate dance comes into play. And David Dickens can help you achieve that. If you have any questions about how to achieve growth, safety, and liquidity, or yield, safety, and liquidity into your portfolio, David can help walk you through and navigate that conversation. 913-317-1414 is the number to call to reach David. That's 913-317-1414. And you can submit your questions to David online at coveryourassetskc.com and begin your conversation there as well. And as always, we'll put contact info in the description of today's show, as well as references to that episode that David was mentioning a little bit earlier on about variable and other types of annuities. There'll be a link for that as well. David, thanks for the help and the assistance. On our next show, we're going to be bringing some listener questions to the program, some feedback that you've gotten over the past couple of weeks from our New Year's resolutions conversations. Those should be fun to get to, and we'll put those on the docket for next time around.
Yeah, I'm excited about that. We've got a couple of questions we already know we're going to use. Maybe another one or two come in, but I think it's going to be a really good show to help clarify the things that we talked about in those financial New Year's resolutions. So I'm looking forward to that. I
heard through the grapevine that one of the questions was kind of challenging you a little bit, so I like that. We like a little conflict. That always makes it for a good story, I think. So.
It does. You got to have a little wrestling match every now and again. So
that's right. Yeah.
It'll be fun.
Don't be afraid for a little pushback, for a little rabble-rousing every once in a while here on the Cover Your Assets KC podcast. So we got a great episode on tap for you next time, so be sure to come back and join us next week for that one. For David Dickens, I'm Walter Storholt. We'll talk to you next time. Thanks for listening.
Investment advisory services offered through Brookstone Capital Management, LLC, BCM, a registered investment advisor. BCM and KC Financial Advisors are independent of each other.